Okay, good afternoon, everyone. I'm Jonathan Swan. I'm going to take you for this afternoon's webinar on modelling methodologies. Again, a nice list of attendees signed in for this one, so it should be interesting. And again, just some quick housekeeping first of all. We're using the Zoom webinar tool today. All of us, I think, now are immersed in the use of Zoom meetings and Teams and things like that. But this is Zoom webinar. It's slightly different in the sense that it's not interactive in the same way as a meeting would be. So I can't see you. Hopefully you can see me, however. The interactivity is limited then to using the toolbar at the bottom of the screen there to indicate if you've got a question to ask me. You can raise your hand or you can send me a note. I'm working on my own today. I've got two screens working on my own, so I should be able to monitor any requests that come in. Be patient with me if I miss you out because I'm too engrossed in the presentation itself. That's the software, and please use it as best you can. There's time for questions at the end as well. So today's theme then is modelling methodologies, and this is a topic, and some of my colleagues are a bit uncomfortable that I should talk about this, because clearly on this opening slide there's some issues there about our competitors. Colleagues are a bit uncomfortable with the idea that I'd be talking about this. But I think I've said in some of my previous webinars, there's a distinction between me and my colleagues. My colleagues are the rocket scientists who do the analytical work, the audit work, and the model development stuff. And they tend to work in quite a rarefied atmosphere, in the sense that they're working with other experts. And when they work with the banks and clients and so forth, they're working with the experts in the bank and with the clients. And so they're working at a very much different level to the vast majority of people that I meet as a trainer, where I go out and meet people who are at the bottom end of the scale, with no disrespect, of course, but they're learning modeling, they're doing a little bit of modeling, they want to improve their modeling skills, but they're certainly not full-time modelers working at the top end of the spectrum. And because I meet people like that, they tend to ask very different questions, because they see things being done in a different way, and labels like Operis, fast, smart, and so forth, and they're not quite sure. So there's more of a conversation that we can have about these different standards, because people do find them. We can't just say, oh, we're Operis and we only stick to the Operis methodology. If I did that, I wouldn't last very long in teaching, because I routinely meet people who've been trained in fast and smart and so forth. So it'd be a difficult way of going about running a course if I didn't accept that people did have different experiences in the past. The object of this presentation then is not to shoot down these competitors at all. That really isn't what I'm after. I had hoped to have sample models representing fast and smart in particular, but we eventually decided we wouldn't do that, primarily because the models that we get are confidential. And that sort of links back to the model audit work that we do. The same principle, we can't be dogmatic about methodology. If we're asked to audit a fast model, then we'll do it, because that's what the client's paying us to do. And likewise, I happen to know the people who run fast and smart and the other ones, and they're in the same position. I know smart is now Mazars, but they will do model audit, and they will happily audit an Operis model. So there's no big issues there at all. It's a very small world, and we all know each other very well. And so really the objective of this then is to show you not what the differences are between these methodologies, but the fact that they are so similar. They are astonishingly similar, and we'll go into that concept in a few minutes. But so if you're looking for a shouting match or something in this session, you aren't going to have it. This is very straightforward. This is what we're going to do. We're going to compare and contrast as best we can. But let's get started then. So one of the things I want to make clear from the outset is the context of the modelling I'm talking about. I can see a couple of civil service friends in the list there, and I've done a lot of work with various departments in the civil service in the UK over the last few years, and indeed in Canada and elsewhere, Canadian government work. And it is very apparent that the world of project finance modelling is very distinct to other forms of modelling. And so with the public sector for a moment, they don't necessarily do project finance modeling. So they don't necessarily do financial statements in the same way that we do. They may be looking at different types of concept of what a project is. Crossrail being a good example. What is that that's being modelled? So there are distinctions here, and also when we look at our colleagues in corporate finance, they look at modelling in a different way. And one of the things I've got on this slide is just teasing out what are the key features of what we call project finance modelling. Well, certainly it's discounted cash flow, DCF type modelling. So we prepare a cash flow, apply metrics such as the NPVs and the IRRs, net present value and internal rate of return, and those sorts of things to the cash flow. Those are the metrics we're working with, debt service cover ratios, moving on to the banking side. Typically, we are looking at financial statements, and the integrated financial statement idea is a reasonable concept. So balance sheet, profit and loss, and cash flow are the deliverables from the model. Typically, again, in project finance, we're doing SPV, so the entity is defined. And again, with the corporate finance sort of idea, in corporate finance, big companies like BP will be doing projects. But they don't need to go to external funding. They can fund it off their own balance sheet, and therefore they will have lots and lots of projects across the organization. Whereas in our treatment of project finance, it's typically the SPV, so one project generating one source of revenue against which has to be applied to all the different costs and financing requirements. And also then we typically see extended timelines. So we can easily, if we're doing PFI, Private Finance Initiative, as was, or PPP, Public-Private Partnership, or P3, as it's often known, those timelines can be 20, 25 years, 30 years. So very extensive, and even broken down then into semi-annual or quarterly modelling. So very extended timelines, a lot of granularity in there in terms of the calculation. Again, contrasting that, say, with our corporate finance colleagues, they tend to work on more discrete approaches to modelling. They may be looking at just one part of the business. They may be focused more on returns in the sense of profits and so forth. In project finance, it's cash flow that we focus on. I've spoken in the past on other webinars about that. But so we're not really interested in dividends and dividend returns and earnings ratios and those sorts of things that our corporate finance colleagues are. And also they're doing things like management buyouts and leverage buyouts and those sorts of things, not so much nowadays. The idea there is that's a short term. A leverage buyout model wouldn't be more than, say, 3 to 5 years, and that would be it. If I'm doing a company valuation, same sort of thing, as long as I've got some sort of thing for calculating the residual value, then they're covered. So their approach to modelling is very different. But the key difference, the really critical difference between their modelling and what I describe as project finance modelling, is the idea of external scrutiny. It's not uncommon for these teams of modelers doing corporate finance to work entirely at their own standards. So the team get together, they decide what they're going to do. And for example, company valuation. I keep coming back to this topic in terms of, can I do a course on company valuation? I used to, and then I've updated it recently, and I'd like to put it in our portfolio for next year. But the trouble with company valuation, unlike DCF straight modelling, is that there are many different approaches to company valuation in terms of the calculation, the handling of the cash flows, the detail of the cash flows, the assumptions you can make, handling of historic data. There's no fixed way of doing it. Whereas when we come to project finance, you're doing a PPP, there is a reasonably certain way of doing it. You've got some creativity in terms of your financing of the project, but overall it's much more focused on the economics of the project and how that's set out. And so our corporate finance colleagues, although they are doing rigorous modelling, I don't dispute that, they're not working in the same environment, and typically their work is not going to go outside the team. In project finance, PPP, PFI, that sort of thing, the models we got that we prepare for our clients are prepared for that client. The client will then share it with a bank. They will obviously at some stage submit it to the government department as part of their bid. There'll be lots of other people scrutinizing the spreadsheet. So there'll be operations people, there'll be the consultants, the specialist advisors, the tax and accounting advisors, the auditors, whether it's us or someone else. It'll be going through to government departments, banks, potential investors, lots and lots of people all looking at the same model. And so the communication aspect of our modeling is quite different. It's much more transparent, much more open. And those are expressions you're going to see come out as we go through the next couple of slides and the next couple of websites I'm going to show you in this context. But external scrutiny for me is the key differentiator. And that's why project finance modeling is so often held up as the exemplar of good modeling practice. But there's a big, huge caveat attached to that. Project finance modeling is, as you see there, distinct. So when we say there's this methodology for doing project finance modeling, great, but it may not work for my government chums there who are doing very different econometric type modeling. They won't have the sort of structure set up. In fact, the structure I'm recommending or would recommend, inputs, workings, outputs, may not be appropriate at all. And they'll be doing lots of data manipulation and so forth. And I've seen that when I go out on my courses. So I really want to encourage you to realize from the outset, there's no one methodology works in all circumstances. And I think it's rather flawed if somebody went out to my course and said that the Operis way is the only way. No, it's not. It'll fall over the moment you try and do a company valuation with historic data. It'll fall over the moment you try and mix periodicities. There are workarounds for it, but clearly a project model, you try and work with fixed periodicities. But if you've got variable periodicities, what we teach may not work. And same to the other methodologies too. So bear in mind then the methodology I'm going through now are all evolved from the world of project finance modeling, okay? And they've stood the test of time and they've stood enormous scrutiny. And that's why I'm respectful of them. Opera is great. We do a particular way of modeling, but as you'll see, it's extremely similar to what the others do, but they're just labeled, they're branded. And that's the distinction. A lot of this, for those of you from government perhaps who don't go on courses and don't know about these particular branding, you may have come up with these ideas by yourself. Certainly, I started out with Lotus 123 Release 2 for DOS back in 1991, single sheet back in those days, but I still had the idea of inputs, workings, outputs. I came up with that approach because I was a scientist in my former career, and when you do a paper for scientific research or presentation, you set out your input methodology at the start, you then describe the experiments, and then you analyze the results. So that's exactly what you do when you write a paper. For me to do that with a single sheet spreadsheet, it was exactly the same thing. And then we had multiple sheets, Excel4 came along, and we followed the same principle, inputs, workings, outputs, and that idea is still there. So a lot of this you may come up with it, and I get people on my courses, they sit there for 2 days, 4 days, 8 days as it now is, and they say, well, what's new about this? And all they've learned is some calculations, and that's great, okay? But it's the methodology, and we'll come to these in the final couple of slides. That will sort of pull it all together in terms of quality control, quality assurance, which are topics you know are very close to my heart. So let's look at some of the ideas here. I'm not going to go into all the detail because you're going to see in a couple of slides. We're all singing from the same hymn sheet in many ways. So the Operis methodology, the one that I would present, the author primarily for that is David Culver, the founder of the company. And I do the writing, do the presentations, do the webinars and stuff, do the training. And so my name is heavily associated with it too. Practical Financial Modeling is the name of my book, which is the exposition of our methodology. But we don't have a formal entry on our website that describes our methodology because it's as we assume, it's common sense principles, and you'll see what the common sense is in just a moment. If I do show you our website, and that's what I propose to do because that's the sort of information I've got, you look on our website, you won't really see a description of our methodology as such. You'll see all the things that we do, the services, it's there. And our branding is very clearly based on this idea of advising in project finance. We've seen so many project finance models over the years, and we've been involved in so many projects that we've got a very strong sense of mission in terms of working for our clients on the advisory side. And that's a very important part of our business, but still the bread and butter is the modeling work. So you probably know about us anyway, because you've worked with us in the past, and some of you I know have attended my courses. So that's enough of the Operis stuff, because you probably know us well enough already. So let's look at the others in my list then. And the first one, and the one I've got a great deal of respect for, is the FAST methodology, the FAST standard as they call it. It stands for flexible, appropriate, structured, transparent. Words we've already encountered. Okay? And the company associated with this is one called F1 F9, and it's run by my friend Morten Searsted. And yes, he is. We have dinner, we go to conferences together and stuff like that. And as you'll see, it's a very incestuous business, as we all tend to know each other. And I challenged Morten a while back on flexible, appropriate, structured, transparent. And yeah, it gives it a nice little acronym, FAST. And they've got a FAST standard, as they call it. And again, if you go to their website, I'm going to try and make sure this one works because it was a little bit hidden just now. So let me see if I can just rattle back to it. There we go. It's there, and it's the next. So there we go. Fast. This is a little bit into their website, but the fast standard, they do call it a standard. And in their promotional materials, their marketing, it's very clear it's a standard. If we just have a quick look at their table of contents here, and this is downloadable. There was a link on the previous slide. You can just click on that and download it. I've got a PDF of it somewhere on my computer there. But there we go. We'll read through these, and you'll see this being repeated in the next few slides. We look at the other methodologies as well. This isn't rocket science. None of it is rocket science. And when we read through this, for those of you who've done an Operis course, this is what you learn on an Operis course. Okay, so design principles. We're pretty much agreed on that. We call it inputs, workings, outputs, but the fast people call it assumptions, calculations, and reports. It's the same thing. We work in the same way. Multiple we'll deal with that. Sheet organization, design principles, calculation blocks. That's exactly what you do. Fixed assets, you do a block for that. Senior debt, you do a block for that. It's all in there. And those are the, there you go, inputs, presentation sheets, and control sheet. Control sheet is what we call an audit sheet. I was teaching that this morning to a group, so that's fine. Line items, so actually the calculations themselves, formula clarity, formula simplicity, boom, we're signed up with that. And in fact, overall, they've got 7 sections. Well, let's go back to 4 main sections. And the rules in short there is worth looking at. I think from memory, there's something like 39 specific rules and 97 breakdown principles from that. And I think at Operis, when we went through it last, we agree with 95 of them and disagree on 2 of them. The classic ones that fall over are the use of range names. Fast, on the spectrum of the world who use range names, Fast is very firmly on the cell reference end of the spectrum, and Operis is right at the other end. And that's pretty much the only thing we disagree on. Everything else we agree on. And if you go on one of their courses and come on one of my courses, you're going to learn exactly the same. Okay. They use a bit of color. They have a bit of coding going on there. They use a few macros, as you can see at the bottom, which we wouldn't. We prefer to use native Excel. So that's really the only other distinction that we have with them. But everything else, the use of index, the avoidance of if, keeping formulas short, left to right consistency, we're there. Okay, it's absolutely there. One of the things that I've found in my experience is fast, or that generally you can stand at one end of the room and look at 3 monitors, each of which has got a different methodology spreadsheet. And the key thing you'll see is the presentational aspect. Fast will have this color scheme. They've got a palette of 6 colors, and Morton always complains to me that I'd never remember the correct colors. It's not my job to teach Fast colors. He can do that. You look at an Operis model, it's very little color, and there's the use of the range names, of course. And then you look at a smart model, and that's laid out almost like a document. It's very, very attractive. Okay, but very little difference once you start clicking on cells and reading the formulas. We all teach the same clarity of thinking, clarity of approach, and simplicity of approach. So that's Fast. Do have a look at it. Again, I'm not promoting them as direct. I'm not being paid by them, but certainly they're there, and it's great stuff. It's good stuff, and I'm not going to argue with it. So Morton Steerstead was the author of that. Smart is the other major one. These first 3 are the ones that you'll come across. So my government friends there will I know these 3 because they'll come across them. In banking, you'll come across them certainly. And all 3 are certainly encountered in the UK and in Europe. Smart has got a big North American presence that I don't think F1 and F9 have. So we regularly encounter Smart when we're doing our work in North America. As you know, we've got a Toronto office. And so they're a competitor of ours specifically in that geography. But it's run by, it is run by my friend Ricky Warnerlid. And he set up a firm called Chorality, and they were taken over by Mazars a few years ago. And there were some issues attached to that, and Mazars now own the brand and own the system. Smart did stand for something. I'm sure it's as specific, measurable, and all the other things Smart normally stands for, but I think there's a nuance there for modeling. But if I show you their website, it's much. There is a Smart standard. They can't find it anymore. And Mazars have sort of subsumed the whole thing. But as you can see here, this is the Chorality financial modeling themes. And guess what? It's accessible, responsive, tailored, keeping it simple, getting it right, allow for change. Okay, these are exactly what you just saw in the FAST table of contents and exactly what you get from an Operis modeling course. Okay, that's exactly what modeling is about. And whether you strap on 20 rules to this or 50 rules to this or 100 rules, it's still going to give you the same quality of product and service at the end of the day. And that's what you're paying for, of course. So SMART is widely used. And again, I do like them. The presentation is quite nice. Another one you'll come across, it wasn't in my original list, but these people crop up. There's a connection coming up in a moment as to why I know about these people, why they know about me. That's coming up in the slide in just a moment. This is BPM, and it stood for Best Practice Modeling, which, yeah, put your nail your hat to the mast there. It's saying exactly what's in the tin there. They've now been taken over by an organisation called Medano, and this is an Australian crew. So we don't regularly encounter them, and same with Smart and Fast. We don't. The world seems to split up around India. I know Fast have got an office in India. We don't. So the world beyond India is dominated by BPM, but they have now been taken over. But they had, and I don't know the status of it at the moment, the Spreadsheet Standards Review Board, which is a very grand sounding organization, but it's very, again, Australian. It didn't really move beyond that. I'd have loved to be involved in something that set itself up at that sort of level, because that isn't branded. It was sort of sponsored by BPM, but it's not branded. It does seem to have a standalone status to it. And again, there's a manual attached to that, so please go and have a look at it. Again, I found their website. There we go. And you're going to start seeing the same things coming up. So take the formatting off of these things. It's all much of a muchness in terms of the services being offered. They're very much focused on modeling with FASTs and SMART, Mazars in particular, and Operis. There's a lot of model audit. But these guys are much more focused on the modeling itself. I think it's quite a good thing to have a firm that does model audit. Because if you just work as BPM Medano now do on the modeling side, you get locked into the methodology. And I think you don't really see broad practice and more current practice, because if you're working in your methodology only, you're going to just stay doing the same solutions for the same problems every time. And I think from model audit, that one of the great things for me as a trainer is getting the feedback from colleagues when they see something interesting and innovative in a client's model that is worth me sharing in training. I'm learning a lot at the moment from Microsoft Excel 365. I held off on that for a long time, but we've all grudgingly, as a firm, had to go across to using it. And there's some interesting issues there with range names I'm learning about. There's a lot of new functions I'm learning about, particularly logical and so forth. So it's a constant process of updating. And that's, again, I know I can't ignore this stuff because my colleagues are seeing it in clients' models when they're auditing. And I think a firm that teaches or works as a modeling firm, if it's got an audit arm as well, then the whole thing is going to be much better because you get this broader perspective. And Medano, I think, is sort of narrowing down nowadays. What else have we got then? I think we're into chartered accountants next. Yeah, ICAEW. I've been working with them. I've written for them as well. I've published with them over about 12, 13 years ago. I wrote a guide to modelling practice. And they got awfully excited. Now, the way that chartered accountants are organised into faculties, so they got IT faculty and they got financial reporting faculty and so forth. And there is a crossover, but where financial modelling sat was a bit uncomfortable, and it ended up with the IT side of things. And the difficulty we had, because we did start many years ago talking about ICAEW as the go-to place for modeling standards, because with 250,000 odd members around the world, if you could get them to work with a group of modeling standards, then you've set a very high benchmark or very clear benchmark. That sort of petered out because they're very good at engaging with their members. And so they'd send out questionnaires about modeling practice, and you've got 250,000 members, you get 250,000 different answers about what they expect of a modeling standard. And so it's sort of all ground to a halt. They did a lot of work over the last decade or so. They produced initially their 20 principles of spreadsheet practice. And they were very clear. They were talking about spreadsheet modeling. And again, some of my government courses are based on spreadsheet modeling to avoid the idea then that when we talk about financial modeling, so many of these bodies are focused on project finance. And those techniques, as I said at the outset, don't always translate well to non-project type work. So the ICAEW came up with the idea then of spreadsheet standards. So there's a lot of stuff there about version control and things like that, the qualitative issues rather than the actual mechanics of the spreadsheet. So there's certainly left to right consistency and a sort of input working output approach if applicable, but they didn't really go too far into it. But they then produced a couple of years ago the financial modeling code. And the issue with that, I don't have any issue really, but the issue is various contributors. So let's have a look at what they've got. And this is their financial modeling code, and read down through the table of contents, and the same topics are coming up again and again. This is fast, this is smart, this is ICAEW, this is BPM, this is Operis. We all talk about the same things. And they've even got my error reduction. I thought I invented that. For 20 odd years, I've been talking about the principle of error reduction, and then it popped up there. Why did it pop up there? Because there's David Culver as one of the authors of it. And David doesn't like my principle of error reduction, but David does like the whole idea, the ethos of error reduction as a guiding principle in modeling. And I've done a lot of webinars on that over the last couple of years. But look at that: model definition, purpose, layout and structure, interface and transparency. Transparency directly from FAST, isn't it? T there. Consistency, we've talked about. Clarity, short formulas and so forth. Clear units, error reduction, including the checks. That's the audit sheet that we would teach. The control sheet, as FAST would call it. Calculation techniques, keeping formulas simple, avoiding hard coding, avoiding circularities. If you've been on one of my courses, you know all this. You've been taught this. So there's no real distinctions here. And right at the bottom there, 20 principles for good spreadsheet practice. That's acknowledging what they had before. But look through the list of contributors. One methodology I haven't got is Numeritas. That's a mission on my part. But as you read down through, Grant Thornton are a FAST organization. There's Mazars, so that's your smart. Operis, of course. Reading down through, I don't know what the others are. Where's the one I was going to look at? There's Modano. Okay, so BPM, that's Mike Hutchins. I know him, as you'll see in a second. Reading down through, Patrick O'Byrne. Notice systems model. I'm going to come back to Patrick in a moment. But down rules starting down there at the bottom, Mazars. Okay, it's this very incestuous community. We all pretty much agreed on what the standards should be. And so any of these documents are very worthy documents to read. I prefer you to buy my book, but these are probably quicker to read rather than my big book. And the common feature for all of these, and the reason we all know each other so well, is if I go to the next slide, is this fabulous organization called Youtsprig, which is the European Spreadsheet Risks Interest Group. I'm going to show you their website in a second. We are all members of this. All of us. Michael Hutchins from Australia comes over for this. Ricky Warnlid, he's a real jet setter. He'll come back for this. We have an annual conference, usually 2 days or 1 day. And it's a mixture then of practitioners and academics. I'm a blend between the two. And so we get together and we have a peer-reviewed journal and we talk about modeling issues. And it's European spreadsheet risk. It's not European, actually. It's international. And one of our founder members is the famous Professor Ray Panko out in Hawaii. He pretty much invented the idea of academic research into errors in spreadsheets. If you don't know Panko, P-A-N-K-O, then look for him now. That'd be a great takeaway for you from this webinar, to go and look at some of his work, because it's pretty much informed everything. And Youtsprig was on the back of that. And Ray's a lovely bloke. He comes over now. I think he's retired now, but he comes over. Youtsprig, then I'll show you the website. Then I want to show you Tom Grossman's contribution. So let's flick back there. So this is the website. Lots of stuff on there about modeling standards and so forth. And the interesting thing then is we do get together, and typically on day 2 we'll have had a dinner at the end of day 1 to break the barriers. So on day 2 we're all mates together again, and then at the end of day 2 we have a plenary, and that's when we stop being mates and we start kicking the tables over and arguing with each other about range names versus cell references and all these sorts of things. It's very entertaining. It's very good fun. But as I said, we do have research and stuff. So there's a call for papers for this year's stuff, the annual conference. Best practice, this is what we really get together and enthuse about, because as you now know, we are all signed up to the same ideas. Fast and smart and BPM and Operis, we're all the same. We absolutely agree on virtually everything. It's just presentational stuff that makes the real differences. Patrick O'Byrne, I pointed out Patrick in the list of the ICAEW contributors. He's the chairman of Youtsprig, and he maintains this lovely library of horror stories of business disasters caused by spreadsheets. There's one, I think, brewing at the moment about some of the COVID statistics. I'm monitoring that one carefully, so I want to see what comes out from that. But presentations of the papers from our conferences, it's all there, and it's now, we do a lot of recording, video stuff, so there's a lot of that. And he's even found some jokes, spreadsheet jokes and stuff, so have a look at that. But Youtsprig then is this great forum where we as experts get together and really talk through what the issues are. And the best practice there is a forum for discussion. And we've got raised stuff, and we've got papers from lots of people who just joined temporarily to attend the conference to learn or contribute to the subject. And we do have academics. One of my favorites was a young Irish doctorate. She did a PhD in range names, would you believe? So imagine that 2 years of your life spending researching the use of range names in spreadsheets. That was an interesting outcome as well. I won't go into that now. I'm going to do another range names presentation very soon, so get to watch out for that. On my slide then, I've got to mention about Tom Grossman's paper. This was a fascinating one. Tom contacted us, oh crikey, it's about 6 or 7 years ago now, and he was planning to write this paper where he's going to compare, I think it was, well, let me show you, I've got the paper while I'm thinking about it. Here's the thing, yeah, so FAST, Operis and BPM, he compared us. And he told us that, he phoned us up and he said, Jonathan, I've got your book, and is there anything you want to add to that? No, there's my exposition of our methodology. He got hold of Morton and the FAST Alliance, FAST Standard, and he got hold of the BPM book as it was then. I can't find it anymore. And the idea was he was going to present to conference. And so it was a July, they were always in July, and I remember going to Greenwich, where where we were that year. And we were all sort of sat on the edge of our seats, and Morton was over there with his cronies, and Michael Hutchins was over there with his cronies, and David and I were sat here on our own because we don't have cronies. And we were on the edge of our seats. What's Tom going to say? Which is the best methodology? And Tom completely took the wind from our sails. He identified quite crucially that in the analysis that he performed, he was looking at sort of lay computer spreadsheet models compared to models that compared using a methodology. And that's why I've focused really on this broad spectrum approach to the methodologies, because his outcome from this was that provided your organization had gone through the process of identifying and adhering to a methodology, then the modeling standards shot up, whatever name you want to prefix in front of standard, but the whole qualitative standard was massively increased because you had standardization, you had colleagues able to interpret each other's spreadsheets and work with them. You didn't have pockets or silos of excellence and not sharing knowledge or skills with colleagues. The fact that you've gone for FAST, or the fact that you've signed up for BPM or SMART or anybody else, that then differentiates you. That really raises the boundary. And that's what he actually found then. The final sentence there, found credible the assertion that spreadsheet engineering methodologies provide enhanced productivity, accuracy, and maintainability for large financial planning models. That's a word I missed out, of course, from my opening slide. The models we're talking about are large. We're not talking about quick and dirty cash flows. I should have mentioned that in that first slide. But that's the issue then, is if you're going to do big work that's going to be going through the process of inspection, you're sharing your work with outside organizations, lenders, investors, whoever, then if you've got a sensible methodology, a coherent methodology, then it's going to be better. And signing up for one of the big well-known methodologies will only improve things. There are some critiques to that I want to do in my sort of final slides, but this is the issue then, is getting people aware of financial modeling as a skill is one thing, because a lot of people just equate it still with spreadsheet skills. And they assume that going on an Excel course will somehow convey and provide them with the skills they need to prepare complex financial models. And if you've been on one of my courses, you've been completely disabused of that. Financial modeling skills draw on a very, very small set of Excel skills, which I think I've talked about in the past. But you do need a good coherent methodology to structure the spreadsheet and then to implement these key skills that you've developed. So do have a look at that paper. It did take the wind out of our sails, as I said, that we were all expecting him to come up with this is the best methodology. It wasn't. It was the fact that you've got a methodology in the first place that will improve your modeling from the outset. So moving towards a conclusion for this, the themes I would tease out, and again, if you saw my presentation just a couple of weeks ago, I was talking about the government's Macpherson report, which is 6 years old or whatever now, but that drew attention across government, and I think to the benefit of the private sector too, about quality assurance. And I've spoken at length about that. Quality control is the methodology stuff. Quality assurance is the fact that the people at the top and the managers and the people who aren't doing the modeling know that there are of abilities in terms of interacting with other people's models. And so quality assurance, I describe it as the environment in which the model is prepared, and quality control is the core of the modeling activity. That's where the modeling is, the checks, the cross checks, the peer review, and eventually through to the external model audit or whatever. But quality assurance informs that whole concept from start to finish. But what I've drawn out from that, I tried to rank these. I was going to put 1, 2, 3, 4 or something, but they all stand alongside each other. The benefit of picking up a consistent methodology, SMART, BPM, Operis, whoever it may be, is consistency. They will look the same, they will feel the same, they will be used in the same way, and you'll get a sense of how you can add to that, add value to that, how your colleagues can work with it, because you've got the same expectations of the product in that sense. Training sort of moves up and down that list depending on your perspective. I said I had a critique about the methodology-based approach, and I'm not singling out FAST for any reason here. It's simply I happen to have seen this, and I've seen it several times. And that is, if you go to your government procurement websites and you search for opportunities in financial modelling, there was a period where the procurement wonks would put in the model must be consistent with the FAST methodology. Now, well, the FAST standard, I should say. And that's a difficult one to address, because what's special about the FAST methodology or the FAST standard is one question, quite legitimate, but it made it easier for the procurement people to just go through their, and I've been involved in government procurement from the other side, so I know this, but they have their list of procurement attributes and they can score you on that. So if you say you're an Operis or a FAST or a BPM, fail. You're out straight away. But oh yeah, it's fast, so tick. I think there's been conversation offline to address that, so we don't see so much of it. The difficult, and again, I'm not singling out fast. It could easily have said Operis. I've seen a job advert once that said we want people who've had Operis training. And that's a great reflection on us, but hang on, what does that actually mean? And the problem with training and standards and that sort of idea is you're only as good as the practice you get. So the mere fact you've done a FAST course, so you know what the FAST standard is, doesn't imply any quality about your modeling. Conversely, again, I'm not being rude about them. If you've been on my course at Operis, it doesn't convey anything about your modeling standards. If you did it 3 years ago and you haven't turned the spreadsheet since, then so what? You've got an Operis training certificate in your portfolio. It means nothing. So training is an ongoing thing. And I thought, do I use the word training or do I use enculturation? Which is a nice big word to use. Enculturation implies then a more of an ongoing process. It's the language that you and your colleagues use. It's the techniques you and your colleagues use. Range names, classic example. At Operis, we teach range names. We're well known even by Microsoft. They know how we use range names. We're held out as an exemplar of range names. And all my colleagues use exactly the same language in their formulas. So when you write your project cash flow, for those of you who attended my course, revenue minus the operating cost, minus working capital, minus capex, minus the tax paid. And that works in every single model. It'll always be the same. But that requires then that level of sort of corporate knowledge distilled out and infused across the team, so everybody knows that. So whether you call it induction training just to get everyone to that standard, or whether you do that as a continuation thing, and that's what part of my webinar program was last year, and we're going to recycle it next year, is the webinars previously we called the Remind Me, because a lot of my webinars are based on techniques covered in the courses that you may have forgotten about. So we did the index, we did range names, we did circularities and stuff, all based on techniques we previously covered that are related to work that you may have forgotten about, but you might be at the moment looking at something where you might need to use iteration, for example. So it's an ongoing process. The training isn't perhaps the correct word there. Discipline, I think, certainly is. It's recognizing that if you're doing a fast standard or an Operis standard or whatever else, that means something, and you can't take shortcuts. So, for example, it's tempting for my colleagues to say, no, well, I'll just stick a couple of cell references in here and just knock this formula out quite quickly. No, we use range names. And likewise, the fast guys, I know, they do actually use range names for things when they're doing macros and stuff like that. So there is that bit there, but it's not a pick it and choose basis. It's trying to be consistent, point one, but discipline then to know that tempting as it is perhaps to do a shortcut, tempting as it is perhaps to stick an input in the middle of the workings, and that applies to all the methodologies. They have that. Tempting as it may be to have a left to right inconsistency in the formulas on the row, that applies to all the methodologies. No, we don't. We endeavor then to say this formula is supposed to be left to right consistent. What can I do to make it so? So it's that discipline. You want to stick at it to solve it that way. And all of this, and this links back to the Youtsprig again, is based on the error reduction idea. That the investment you put in to training, to the discipline, to the consistency, all those things, and you've identified a particular methodology that you're particularly attracted to, it's going to give you error reduction. None of these methodologies at all offer error proofing. Okay? It's simply a concept that doesn't exist. We can't error proof. So an Operis model could end up at Mazars being audited and they'll find an issue with it. And likewise, we get a smart model from Ricky and we find an issue with it. It's great. That's why you pay auditors, and that's why we charge such high fees, is we go through extremely carefully. But no matter how good your modeling is and how good the team is, there will be issues. There's no question. And one of the things that Youtsprig tend to get hung up with in a lot of their research is the minutiae, as I call it, of the formulas in the cells themselves. So and if you've been on my courses, you know I moan about if all the time. But if is not problematic. It's problematic because it's more likely to be wrong. Statistically, it's more likely to be wrong. Cell reference formulas are statistically more likely to be wrong. Well, you come along and you slap on a fast discipline on top of that, then your cell references are less likely to be wrong. Okay, it's simply that idea again, back to discipline, back to standard methodology. So again, the Youtsprig research, valuable as it is, will often focus on, and they've got a lovely expression, they call it end user computing, end user computing, EUC. And a lot of it's focused then on, and I mentioned Ruth, the PhD on range names. Her focus was on people who'd not actually been trained on range names. And so she got some interesting research findings from that showed that errors soared when the end user computer people were asked to do range names or look at range name formulas because they didn't understand them. Okay, so when they were educated into using range names consistently and with discipline, then the error levels dropped off substantially because they're, as we describe, natural language formulas. Separate debate, but it's that sort of idea then. And one of the final points I would make from all of that, then error reduction subsumes all of this, everything, all those rules, all the FAST rules, the ICAEW rules, all of those things are all geared towards error reduction. And what we try and do, and I think that's a useful one for the ICAEW in particular, is they're slightly distancing themselves from the project finance approach. So they're trying to be more generic. That's why I've got their 20 spreadsheet principles. The financial modeling is still linking back to a bit of the project, the timeline stuff, but they're trying to be quite generic as well for that, to try and make it open to as many types of modeling as is possible. Okay, so methodologies are great. There's no, I would argue, no substantial qualitative difference between any of them. And if I got together with, and this was a sort of pipe dream of doing this particular webinar, is getting together with Ricky and Morton and just going through this and chewing the fat together. But in this case, we decided not to. It's just enough to say the methodologies are there. You will encounter them. They do have their benefits, but it's this final slide that really draws your attention to why they have benefit. If you've done an Operis course 4 years ago and you've done very little since, then what benefit is there? It's got to be an ongoing process. If you've got an Operis model or a fast model, great, you know that it's been built in a particular way, and you will expect certain features of it. But you will then know that if it has been built by a trained Operis modeler using the Operis methodology, or one of Ricky Warnled's colleagues using the SMART methodology at Mazars, you will know that that model will be of a very, very high standard. And that's really what Tom was finding in his research, that it's the quality improvement that you get from all of this that gives you the benefit. And if you're doing cost-benefit analysis, that's the outcome: fewer errors and better decision making. And really, that's what financial modelling is all about. So that's my little bit on the soapbox about the methods. I would like, as I said, to show you examples of these models, but I'm sure we can get hold of them next time, or we'll put something up on our website for you. But they're out there. I've seen on the government websites, I've got friends there from Ofgem and Ofwat, and they tend to use a fast type approach, and they publish their models. So their regulatory pricing models and so forth are on their websites for public inspection. So do go and have a look, and you will see straight away that they are generally fast models. And you'll recognize that because they've got the 6 colors, instant diagnostic. Okay, if you saw one of our models on a website, it's full of range names. Okay, another diagnostic. Okay, and if you see one of Ricky's smart models, it's got paragraph numbering. So 1.0 inflation, 1.1 inflation rate, 1.2 inflation index. It's all set up like that. Lovely. It reads really well. I'm going to finish there then, if I may. I haven't seen any questions coming up. I'm just scanning through my screen. Nothing there at the moment. If you have any questions, please do ask me. My final slide there is the usual end plate that just says about our modelling standards and our courses. We've got them as classroom courses, if only, at the moment. A lot of work on online courses. We've been very busy over the summer with online courses. I'm running one this week as well, and I've got one next week to follow on. And we've just doing the self-study. So that's an online package where you can download the recordings and watch the model being built, and then put it into practice for yourself. So it's completely self-study rather than interacting with the trainer. But in all cases, please get in contact with me if you've got any questions. jswan@operis.com. Sorry, I just wanted a question coming up, so bear with me. Gary, that's an interesting one. I'm being asked here, if you follow a certain methodology, e.g. FAST, are you allowed to self-certify that your model follows the FAST standard? Yes, and that neatly addresses something about FAST, because they promote actively the idea of the FAST standard and the FAST alliance, which SMART and the others don't tend to do in the same way. They are very distinct, so you will recognize that it is a FAST model, but you can then certify that it follows the FAST standard, but I'd be very cautious about any qualitative inference from that. Are you actually saying that it passes a particular threshold of I would say, audit checking? Okay? That's the difficulty you've got. So you could, and I'm just being rude, you could build a model to the FAST standard. You can put a note on the front, a logo, because you're allowed to. So you could put a FAST standard logo on the model and still have a balance sheet that doesn't balance. That's very rude, because of course you wouldn't. You would have a balance sheet, but it's that sort of idea that it doesn't imply any qualitative standard. All it says is a methodological standard has been followed. So I think that's a great question, actually. That's quite a good one. With Operis and the others, it would just be your model. So it would be, just trying to think, it'd be a PwC model, it would be a HSBC model, it'd be whatever model that is then following these standards. Whereas with the FAST, they do tend to promote that idea that this is a FAST standard model. And by the way, I'm working off what, or Ofgem or something like that. Okay. So that's a nice distinction. So a very good question. Thank you for that. Any others? Oh, I can see another one. Is that the one? No, same one. How do I get rid of that? Dismiss, right. Thank you. Any other questions? No. Okay, so plugging the courses there and the various models now to follow for teaching purposes. Oak is our Operis analysis kit. My colleague Rui Sobreros, some of you know, some of you know him. He is the manager for that, and he runs regular webinars to explain how the Operis analysis kit audit tools can be used. It's a commercial software tool, so you can download it and formula auditing and so forth. Webinar program, we're just about to do our Q1 program for next year. As I said, we're reverting back to the remind me approach. We've for the last 4 sessions of the last quarter, we've gone to this more generic modeling issues thing. So we've been looking at Macpherson, quality assurance, quality control, and these sorts of things. But we're going to revert back to more technical things for the first part of next year. My next webinar for your reference is on the 2nd December. I've actually written it down this time. I normally forget, don't I? 2nd December, and it's on integrated financial statements, a topic I've mentioned previously in this presentation. And that's basically the idea that financial statements are core to project finance models. And unlike the accountant who would evolve the outputs through a process of revenues, costs, and so forth, we tend to start with the output sheet approach to begin with, the financial statements, and the expectation then from the outset that the balance sheet will balance, that movements on the retained earnings on the balance sheet match the movements shown on the income statement, and movements of cash on the balance sheet match the movements of cash on the cash flow report. So the integration built into that. And that's what we're exploring next time. So it's a bit more hands-on. It's an interesting topic. So if you're all happy with that, thank you all for joining me this afternoon. It's nice to see such a nice audience. And so look forward to seeing you again on the 2nd of December. So thank you, and we'll finish there.